following Nigeria today. Central banks in several regional economies will be announcing their interest rates outlook this week. For a brief overview of the decisions facing African central banks in West Africa, we're now joined by Samir Gadio. He's in Lagos. He's an African market strategist at Standard Bank. Thanks so much for your time there, Samir. So basically, the central bank and the MPC took a more cautious approach to inflation trends this year. They've decided to keep rates on hold, but the caveat is that the recent partial removal of fuel subsidies is expected to have a lag impact on the economy. And so by mid-year, inflation could have ticked up in Nigeria. So what does that mean then?
Well, I think, the interest rate decision was basically expected. I mean, the market consensus was that it would stay at 12%. And besides, the central bank governor had made the point that they would not hike based on the first rounds of inflationary pressure coming from the increase in fuel prices. And also, it was somewhat obvious because the Naira-dollar exchange rate had remained stable at 160, 162 in recent weeks, even though the central bank had stayed out of the market. So I think this decision was expected. As you said, inflation will increase later this year, but it's more a transitory shock because the CPI will move to a higher base. So we expect inflation to peak at probably 14.5% year on year in July, August, and there will be a month-on-month increase in January above average figures.
I mean, obviously, the central bank has tended to make the stability of prices and the stability of the Naira a key element of its monetary policy. Although trading in a much higher band, the Naira is stable, somewhere in the region of 161 Naira. It's been trading that way for the last 2 months or so. So what are expectations for the currency, and how will that impact on any decisions that the central bank needs to make in future?
Well, I think that's really the key issue because in the central bank's view, if you let the currency go higher, so in other words, if the Naira depreciates, it's going to have a negative impact on imported inflation, and also it might create actually a macroeconomic shock at some point. So we think that the central bank will be okay with an NPR at 12% throughout the year if there is no pressure on the exchange rate. But that's not a given. As you know, fiscal policy remains extremely loose, and so we can expect that at some point we'll see some episodic weakness in the exchange rate as in 2011. So the jury is still out, frankly.
Fiscal policy, going back to the Nigerian government, its propensity to spend. On paper, we've heard, or rather in pronouncements, we've heard authorities say they're going to rein in spending. But there's still talk of increasing the benchmark oil price to $75, and it's on that basis that the budget for this year and the next may be set. What bearing is that going to have?
Well, to some extent, an increase in the oil price benchmark to $75 per barrel from 70 is not probably that significant, but it shows you that some segments of the political elite in Nigeria are still opposed to the notion of fiscal consolidation, and that's a concern. And we see the same issue when it comes to the sovereign wealth fund, which was passed into law in May 2011, but has not been effectively launched. So we are in a very vicious cycle in the sense that government revenue is actually increasing, but everything is shared among the 3 tiers of government. So the country is unable to rebuild foreign reserves, unlike other oil-producing countries in Africa. For example, Angola doubled its foreign reserves in a year and a half or so. So this is a problem.
Another problem is that bank credit has been slow. It's improved a little bit, but it's still slow in terms of money that's going into the real economy. A lot of businesses have had to shut down in Nigeria. The big focus has been on bank reforms and dealing with systemic risks and getting AMCON to mop up non-performing loans, etc. Now that we're at the tail end of those reforms, will credit start to flow?
Well, I mean, to some extent, if you look at the CBN figures, private sector credit year on year has actually increased. But let's not forget that we're coming from a very low base. So in other words, especially in early 2012, what we'll see is that there will be a rebound in private sector lending because when AMCON acquired the NPLs of the banks in early 2011, those NPLs were basically removed from the private sector credit time series. So there will be a low base effect. But in practical terms, what we've seen is that with the exception of tier one names, other segments of the credit market have obviously suffered a lot because lending rates have increased drastically, and some banks have actually raised their lending rates by 300, 500 basis points recently.
There's also a big need, Samir, to get investors back into the Nigerian market, particularly through bond markets that have been relaxed and make it easier for people to bring their money into the country. When they look at interest rates at 12%, when they look at bond deals attractive between 14 and 19%, but they consider the near future for Nigeria, how will that influence their decisions?
Well, I think yes, you're raising a very interesting point. Although the MPR is at 12%, in reality, the one-year T-bill has fluctuated between 18 and 20% in recent months. So you have a very attractive carry trade at the short end of the curve. And increasingly, we're starting to see some interest in the short end of the Nigerian fixed income market. I mean, some investors are still concerned about the FX outlook. The fact that foreign reserves are not increasing. And so obviously, if you have some improvement on that front, I think that the country will generate some increasing inflows on the fixed income side.
All right. Will central banks in the region follow off the cue of the Nigerian central bank, which has been very aggressive in hiking interest rates, although not today, which has been very preoccupied with price stability, which has been very critical of a lack of fiscal restraint? That's been the approach of the Central Bank of Nigeria. What's the approach in other West African markets?
Well, in West Africa specifically, I don't think that we're going to have a massive increase in policy rates, probably not even any increase at all in Ghana, but that's in terms of policy rates. However, what we've seen is that the yield curve has started to shift up. So I think that's likely to be sustained because, as you know, the city is under pressure, and to some extent, in relative terms, Ghana is not really attractive anymore as an investment destination because rates are lower than in Nigeria and Kenya and Uganda and so on. In the CFA countries, it's a different policy framework. The central bank there wants to keep interest rates stable, and they have been stable since 2009. The prime rate has been at 4.25%, so that's unlikely to change. And in fact, what we can see is that in East Africa, probably in coming weeks or months, the monetary policy framework is going to be eased because inflation is starting to turn. So you have a mixed picture across Africa, actually. I don't think that we can generalize.